Pleased to have my good friend, Dr. Xifan Wang here. He's a quantitative research analyst for Salient's energy infrastructure complex. Salient is a big fund. It used to have $6 billion under management, but I don't know where it is today. His primary responsibilities include statistical research and analysis on fundamental and market data, as well as building new quantitative models. And he continues building quantitative models that outperform the rest of these discretionary models that most of the rest of the fund uses, and that's very amazing. And he's been doing this for the last 2 years now, and it's very consistent. So he's going to talk a little bit about that, as well as the SPACs. Before he joined Salient in June 2020, Dr. Wang served as a researcher in the Department of Space Physics and Astronomy, and mainly focused on modeling in condensed matter physics, I kid you not, and optical topics, where he received his doctoral degree. He got a BS from Sichaun University and an MS from University of Dayton. And we have been working together since fall of 2018.
That's right.
When he was a student.
That's right. It's been a long time, right?
Yeah, well, we're all turning into old timers. That's the funny thing. He's taken 682, 686, 699 a bunch of times, and since then we've given up and just had him come speak to us. And that's what he's going to do. He's an independent research. And he was also one of my research assistants and did some very amazing work. And with no further ado, I will turn it over to you.
All right. Thank you. Thank you, John. Give a great introduction. So here today we're gonna discuss everything about SPAC. If you know, and any of you did trading at all? Trading at all? Yes. And heard about terminology about SPACs. And you bought some SPAC? No. Good for you. Good for you. So SPAC is very interesting, but actually you can make a bond-like, better than bond-like return for SPACs to hedge the inflation, especially at the high inflation environment. So let's get started. So in this presentation, I'm going to first talk about what is SPAC and how is SPAC structured. You guys maybe know the terminology, but you may not know how SPAC structured in detail, and why SPAC was actually not use is, but should use was very popular since the late 2019, and it's very populated in 2020, and get a booming in 2021, and then they get crushed in since later 2021. And basically, in the bottom line is what we can do with SPAC. So there are several strategies you can play with SPAC, actually making decent amount of money. For example, you can short these SPAC to making maybe 10% return amounts, and I will show you guys how that works. But those days are very difficult to locate. It's very difficult. We made something. So what is SPAC? SPACs stand for Special Purpose Acquisition Company, and it's a shared company. It doesn't have any business model. The target for SPAC is basically a bunch of people raising money through the underwriter, and they're looking for a real company, a private company, and merge with to turn the private company into a public company. That's how SPAC works. And that's why they use the SPAC as a vehicle to go public. There are several advantages and disadvantages we're going to discuss later in this class. But let's look at the SPAC capital structure first. So in ordinary, the SPAC typically IPO with a bundle. What we call a bundle is called a unit. In this case, SPAC in 99% of the SPAC is offered at $10 for the bundle, which in a typical structure you get 1 share and plus a quarter to 1 warrant, depending on the SPAC teams and what their perspectives are. And basically it's very difficult for retail investor to participate the SPAC IPO. Only the institutional player is doing SPAC IPO. So in those days, a lot of SPAC gonna overfund in the trust to attract the institutional buyer to buy the SPACs. So right now I'm gonna take a second and let's go into some statistical data on this SPAC thing. So here you can see that's a chart from a website called SPAC Insider. They get very good data for the. They have very good database on SPACs, no matter which stage, from pre-IPO to IPO and announced year and de-SPAC. They got all type of data you can look at as reference. So let's see on those columns you can see the IPO procedure typically very standard 200 million is about the average size. They raise about 200 million to the underwriters. And you can see the what's the percentage holding the trust. You can see those days typically above $10. So the one we did yesterday is 1030, which means it's about 3% above the IPO price. So give an example. Yesterday we participated in this IPO. We bought. I don't know what's our final allocation are. It's kind of coming out in maybe several minutes. I don't know. But we bought it $10 at the unit. So we get like one share plus the half warrant in a unit. And the thing at the trust value for the share actually was 1030. Basically, either we after 15, because this one only have 15 months lifetime. After 15 months, we either can choose redeem our share at 1030, or when it's very close to the fair value of the trust, we just sell on the open market. And we most probably we're gonna sell the warrants when they separate trading it. So this is they just overfund the trust to attract the buyer. So that's how you can make money, right? It's about if you consider the return, we can calculate it here. You get 1030. When you buy 10, you can get 1030, and within 15 months. So basically, it's 3% in 15 months plus you get a half warrants. Half a warrant maybe was 20 cents. You can consider it as out of the money 2 years option. 1-to-1 option is not 1-to-100 option. And you can get, on average, you can get a 4 to 5% return within 15 months. It's very decent. It's better than bond. And if you can add one-term leverage, you can make basically high single-digit return from 7 to 8% annualized, which is very good for this environmental. So we get some big clients coming to us from this strategy, and it's doing very well. All right, let's move back to the structure for the SPAC. So in SPAC, they get a founder. Where am I? Okay. So when you look SPAC management team, they get an incentive to buy fund idea. Typically, they can get a fraction of the founder share from the SPACs. If they succeed, found a private company and made the acquisition, they're gonna get an incentive. So in most of the cases, those SPACs management team are formed by very extremely experienced retired CEO, CIO for some big companies, which they have tons of connection in the industry. It's easy to get a fair value of the private company, plus they know which company they should buy. So that's how the thing works. So here, give an example for the Wang SPAC. I reviewed their pipe deal called CBI. They did a renewable deal for the top roofing, the roofing top solar panel at industrial level. You can see their management team. Most of them are from those high level experience. Either you can say the investment bank and the industrial. So that's how the typical SPAC team looks like. And they typically, the whole team maybe get, I'll say around, mostly on average, they will get 3% of the total, the total share of the SPAC after acquisition. So that's their motivations, because they get free founder share. If they get a 1 year lockup period, but if they can make a succeed acquisition, they typically can make several million at least for that purpose. That's why there's so many SPAC on the market.
Are these set up as C corps?
Yes. Typically, most they are C corps. So this is another example of SPAC management team, how it looks like. Basically, they found an EV they are climate really impact solution. So once they get a very good successful deal down, they're gonna launch SPAC 2, SPAC 3, etc. Because they can play the game all day long as far as they can find a deal and get it done within the lifetime of SPAC. So the typical SPAC has 2 years lifetime on average, but sometimes it could be shortened. Those days they try to shorten SPAC lifetime and get the deal done, rush the deal done as soon as possible because the space is so crowded. Then let's take a look on the some of SPAC numbers. If you scroll all the way down, you can see it's above. Maybe this one has better data. The Canada has better data. If you look at those searching years, it's about 600, over 600 SPACs are looking for private company to merge. So it's that rate, we believe there's gonna be a disaster later this year because a lot of SPAC only have 2 year lifetime, and they launched earlier last year and in late 2019. They have to rush the deal down. So that's why you're gonna see a lot of shitty deal on the market, and we tend to short those deals if you can get a borrow. It's very difficult, but not impossible. You maybe get 1 sound or 10 sound short on some of the names, and you can make a decent amount of return within a couple of days. Go ahead.
Why is it that SPACs typically only have a 2-year lifetime?
That's written by the, that's a two reason. First of all is the SEC requirement. You cannot have infinite time to looking for a target. The second is more like you get this incentive thing because if you don't have 2 year time for the management team, they can take a long time, they can relax, do whatever. And for the SPAC IPO investor, you want to get a deal done as soon as possible. Either you can redeem your IPO share, it's a trust value, or you can sell on the open market, or you can, if you like the company, you can hold the share. So that's why we want the lifetime of SPAC is short, but it's not too short, difficult for them to find a deal. So 2 years is most like a fair value for a fair lifetime for a SPAC. So that's a reason. So how to do that, and that's fair, I would say. And if you look at 600 number SPACs, I would say at least half them cannot find a deal because basically we can see only 1 to maybe only on average you can see 1 deal announced every trading days, not even calendar days. So which means in a year you only can get slightly above 200 deal get closed. So another rest of that cannot find deal. So which is good for us, but very bad for the risk capital investor. They're gonna lost all the money. So I will explain the risk capital structure later on. All right, as you know the numbers. We can take a look on the announced deal. It's about like 106 SPACs found the target and waiting for the SEC to approve the deal and they can close the deal. The typically time frame is about 5 months those days. SEC is not very efficient. So there's opportunities. I will explain later on what we did for those type of strategy. So here I can explain detail way in the SPAC lifetime. Sorry. Yes. All right. That's. The whole procedure, you have to first to file S1 for IPO, and you gotta write what's the target company or the target field you are looking for a private company to merge. And the second, you have to write what's the target size you want to rise through the IPO, and will also your underwriter. Then we'll select the data, everything got green light from SEC. And they said, oh, we are ready to go. And you pay the money for the underwriter for the fees to IPO. Then you can launch your IPO. And basically, your underwriter gonna help you to fund the buyer to buy your IPO shares. Then you get the time to looking for your target private company. Typically, as I mentioned, in the older days, it could be 2 years, and this year typically they have 18 months structure because it's. I would think those days, if you want to ask back IPO, definitely you better already find a target and launch it, even though it's not auto, but you can say that. Then you get they're gonna negotiate with the target company, get the detailed structure. What's a term? What's a like enterprise value for the target company? Let's say maybe 10 times EBITDA, like 2023, 2025 EBITDA. It's depending on how they do the evaluation, and they have some. In this procedure, they're gonna have some nasty things going on. Then, in the next stage, they want to have a private investor to join them to secure the transaction. For example, if you are looking for a private company and you didn't raise up any private investment in public equity. So if you don't do that if your IPO share get redeemed, most likely those days you get 90% redemption in the IPO shares. You get screwed up. You cannot close the deal because if you are the private company, go through a SPAC, you cannot raise a bunch of cash and go to public, and you have to dilute your shares. Why you do that? There's no point. You want to do that, right? Unless you can go through a SPAC procedure and raise enough cash to cover your research and development for the next couple of years, you would do that. Otherwise, you wouldn't do that because you have to dilute your shares with IPO shares and also to the SPAC management team, which they help you go to public. So that's why they typically looking for PIPE deals. And we did actually 3 PIPE deals. One was very successful with Rice acquisition. They did a renewable natural gas company called Kia Energy, and the stock I believe is trading around $18. We bought 20 million pipe on this company and we also have very shitty deal. CoFES, which is a battery company, I think it's trading somewhere around $7. So basically, we lost 30% from that money. But we didn't do much. We did 8 million on that one, and we also did it for the one of the other companies, more like a disruptive renewable energy, which is trading at $5 right now. So you can't handle the risk for those kind of deals. So because those are like a hyper growth company, especially in the high inflation environmental, the company value gonna be like crushed during the high inflation period. That's why. And plus, for the PIPE investor, you have a 3 months lockup period. You cannot sell your shares within 3 months after the deal closed. So they got more new structure going on those days. They more like have a preferred preferred equity type of structure, and they gave typically they also give the pipe investor a $8 floor to exit. So basically, if you invest $10, you can exit it at $8. That's what they claim these days to protect those pipe investors. Otherwise, they don't want to do that. Then, when you have the pipe investor join the investment, and you just submit all the paperwork to SEC, waiting the SEC to get approved. In this time period, typically could take a year for some international deals, but in the domestic, typically average time could be 4 to 5 months. So you gotta expect 120 days to 150 days on average to close the deal. So then you have to have the shareholders vote your merge. But 99% of the time they're gonna approve. That's the reason. If I'm the IPO shareholder, I don't like the deal, I want to exit, I'd rather to approve the deal because that way I can get my IPO share redeemed in cash. If you like the deal, of course you want to approve this deal, right? Then you can hold the real company's shares. Besides, the management team always wants to get the deal done, then they can make an incentive after a year lockup period. Then the last procedure is de-SPAC and close the deal. When they get the vote done, the exit protection is gone, so you'll never be able to redeem your share at $10 or the trust, or even $10.30, the trust value of the shares. You just became a holder any real public company shares. Basically, that's no protection anymore. So that's the whole lifetime of SPAC. So if you look here, you can see typically a flow chart how things goes, and if they reach agreement, they're moving forward to meet the further investor and the pipe investor. If not, they get returned to the target searching procedure. We saw several deal break since the last December because there's several reasons. One reason is the valuation was high since earlier 2021. All the company you can see all the crazy things going on. Company are valued at 30 times EBITDA. It's 25 EBITDA. 2025 EBITDA is project number, and they never be able to reach that number. So typically you have to give 20% discount on where they projected for the 2025 EBITDA. And so one credit company called Solid Work, I have a meeting with their team. They told me they are working on a solid battery, which could have a huge potential. But the problem is they told me we cannot have industrial level production until 2028. I said that's bullshit. It's too far away. You guys shouldn't go to public market. You should stay in the startup stage. Then they are evaluate the company at a very high enterprise value. So I like, no, it's not gonna work. So I turned down the deal. So we cannot invest that money. And things like that. Also, some companies, autopilot driving system company was asking for 80x 2025 EBITDA. That's way ridiculous to do that. Basically, I don't trust that you guys can succeed. Then eventually the deal.
Do they actually quote you these multiples, or do they give you numerical value?
Numerical value. So basically, they get a third party. I believe it's mostly done by the underwriter. Basically, the sales side, they did the financial model for those companies, but in 99% of the time they are wrong. The projection is way higher than your expectation. And when I look at the thing, you guys grow your revenue 10x every year. It's not feasible for me. I don't think it's gonna happen. There's no way you can reach that point. So, but that's what you can see. It's really happening in the world. In those pipe meetings, they are showing up like, no, I'm not a VC type of investor. We cannot do that. Yeah. So it's better it created a lot of chaos, but also some opportunities. You have to keep your eyes open to find the good deals. So here's the screenshot of the front page of the S1 file for a SPAC, which is a social capital. It's a very popular one. This guy have been launched at least 6 or 8 SPACs, and they get some the Virgin Galaxy and other 2 or 3 like good company, etc. through their SPACs. And you can see they write like a 35 what's a unit? 35 million unit, which means like $10 per unit. The IPO size is going to be 350 million. That's the money they try to raise through the IPO. And you also can see there's the price to public and how much the underwriter gonna take the commissions. That's the money they gotta pay for the underwriter called risk capital. We can see it. Yeah, that's basically the table content, and here they got a proposed which area, which type of company they are looking for. So basically, they state here they are looking for the technology sector company for their SPAC. So you can expect what type of company they're looking for, and it's very popular in the last year if you're looking for a renewable or energy transition sector or like a electrical vehicle, etc. Those type of sectors, they are really like doing that and get a lot of traction. If you recall, the craziness is 2021 February. Those things go to IPO, they did nothing, the price jumped to $11, $12. They didn't even have a target. They are like 20% above the trust value. Who's gonna buy that? I just have a question. Who's gonna buy that? That's crazy. That's the craziness of the IPO. Then, because a lot of people saw that phenomenon, then you saw like the next month you get 50 IPO for SPACs. Then everybody trying to rush into the market and be trading higher. Then people realize they didn't have anything yet. Then they get a correction, trading below the trust value, which is the correct way because you always have some premium for the discount premium for the trust value because of the waiting time period. Yeah, that's the story happening. And now those days, most of the SPAC are trading like shit. I would say that. So here's one of the old things. They made this graph on 2020, and it shows up like what's the SPAC size. It's about like 500 million and the mid range, and what's the target looking for. And they also shows up some announced deal at the bottom and closed deal. In fact, in the SPACs, this graph, there's 2 companies trading well. Particularly, if you look at the DraftKings, I think is trading at $16 or $18, and this one at the MP Materials, that's the only rare earth producer in USA. Actually, is trading at $45, which means if the team can find a very good company, they actually can make a lot of like an incentive fee on that deal. But it's very real. It's I think 1 out of 100, even less those days, because the valuation get crushed. So then, when you find a target company, you think you want to have some pipe investor to back up you guys and to get the deal done. Now let's look up what's typically pipe size and how it looks like. We can move to some announced deal here because they get a better data. Let's give example. This company AMCI Acquisition Corp 2, which is their second SPAC. They have a recent announcement earlier this week. We can see announced date March 8th, which is I remember it's Tuesday, and it's a carbon company, and they have IPO size. This is the IPO size, and this is a pipe size. So basically, 125 million is a pipe size. However, the minimum cash condition to close the deal is 250, which means they need 72% of their IPO money to close the deal. If during this period they cannot more pipe investor add the money into the pipe size, they may get some trouble to close the deal. Maybe at the end of the day, the deal gonna break. They have to back to a searching mode again, and you can say the last price of trading is 9.79. Basically, you can buy the share at 9.79. Potentially, within 5 months, you can redeem it at $10. It's not a bad deal. As a 2%, you consider 6 months lifetime of the 6 months waiting time for the SEC to approve the deal. If the deal get approved, yeah, you get the money. And the other deal you can see, it's very good. It's trading at 9.85. The trust value is 10.05, means $20. 20 cent discount from that, and you can buy that and redeem it for the 20 cents. 20-cent gain within five months, which is not bad if you consider. It's annualized, you are more than 4%, right? It's decent. And you have a minimized risk because if the thing goes even lower, you always have a $10 exit to get your money back. That's very important. Also very important to read a message from your broker. If you bought the broker gonna send you a message twice to remind you want to redeem your share before XY date. Was the final decision made, and you can say it's like carbon emission company. Those days, the green tech, some those things are very popular. You can see the enterprise value is 1.8 billion. It's high to me, but I don't know how they calculate it. But those days, they typically downsize enterprise value to that. And some popular company, you even can see the price is trading above this trust value. So people hope the company, the target company, the good company. You can see it's the crypto exchange. That's why it's very popular. It's a crypto exchange. So they believe it be because the craziness happening in the crypto currency, it could have a good cash flow for the business. And for most of those things, you can see it's about 20 to 30 cents below, actually most like 20 to 25 cents below the trust value, which means you can make about 2% return in 5-6 months, which I would say fair. I wouldn't say anything wrong with that, but it's kind of bond type of return you're expecting, actually better. Okay, let's move back to the how the SPAC structure looks like, the transaction structure. So after they get a public invest done, let's say this one we had, we have participated in this pipe deal called Sina hydrogen transaction. And as you can see here, on the source, so the total they did an estimation on like if all the IPO shareholder gonna roll over into the public company, they're gonna add like 250 million like in cash, and also we also have raised up 200 million as a private investor, so they get some like cash adding to their balance sheets for them to like establish the next 2 or 3 years for the R&D project. So this company is doing a concentrated solar power company project to like basically they use mirrors to reflect solar power to a single point to heat the target up to above 1,000 Celsius and to storage the heat in a insulating chamber using that heat to do mainly for like heavy industry purpose. They have clients, Rio Tinto, BP, BHP, those big like mining company to refining those mines. They need like go green, so that's how they can get sufficient enough energy. That's why we think this might be a game changer. So we put some money for this. But now the thing is trading at $5. It's kind of frustrating, but it's fine. It's only like less than 1% in our total portfolio, so we are fine. It not hurt us. It's hurting us, but not hurt us that much. So on the pie chart, you can see the structure of the pro forma ownership. You can see the original, the hydrogen company shareholder can get 77% of the total shares, and the pipe share investor you get like 8%, 8.3%. And here is a very juicy part. That's why they are motivated to like doing a SPAC and fund idea getting done, because they can get like 4.3% of the total shares. Even though if you cut the value into half, they still like was 5 million shares. That's a lot, because those shares still was $5 at this moment. And after a year, they can redeem this money. So they can sell this money, sell those shares on public market. So that's their major motivation why they want to do it. If the deal is very good, for example, the MP materials, they can make, those management team can make up to like more than like 100 million on the deal for their 2 years for to fund time. That's how they play the game. So for the merge process, it's kind of like you get the deal done, you have the phase get the negotiate down with the public investor, you make an official announcement, you submit all the materials to the to SEC, just waiting them to approve it. When they get approved, you are good to go. So then you can get the investor meeting, etc., to get the shareholder to vote for the thing. So in most of the cases, the deal get approved. Only very few cases they don't get enough vote on the shareholder voting, because a lot of shareholders forget to vote. Then they have to postpone to set up another date to postpone the close date. Typically, they have to months to prepare that, but that's very rare. It's not a very usual. It could happen. So, so why SPAC is popular since last year, or even late 2019? I have some statistics. So for the sponsor, because the sponsor can, which I mean is the guys back the SPAC team who paid for the risk capital for the underwriter fee. Basically, they just paid for the underwriter fee. They can get a big chunk of economy, big chunk of the share from there. That's why they do that. The risk reward, the potential is high, but they take the biggest risk. If they cannot get a deal, they can lose all the money. So typically, the risk capital is about what's the size of the IPO? If you do a 200 million IPO, you're gonna pay roughly around 5 million to 7 million for the risk capital, depending on the underwriter. Some like a shitty underwriter, you might be able to negotiate down for the fee even lower, but they don't have a strong network to get well-distributed clients. Some high-end underwriter like Goldman Sachs or like Morgan Stanley, they require high fee for like maybe 3% and 3.5% for the IPO size. All right, for the IPO investor, especially if you can participate in IPO, it's very nice. We can get a higher single-digit return within 2 years. We like that, especially for institutional one, and we get a lot of clients are looking for like a income type of product. They like it. because they want to minimize the risk, no volatility, and has a better than bound return. That's what they are asking for. Plus the liquidity is plenty during the in the public trading. Even though it's not as liquid as you thought, but it's liquid enough, we can exit all the position within a week. Okay. Then the third is warranted is always a bonus. As we can see, in some extraordinary cases, things can go extremely well. Let's say a particular Trump-related SPAC name. If any of you heard this ticker name, DWAC became a mammoth stock eventually. It's a SPAC now trading $73. The underlying the target company is called the Truth Media. It's sponsored by Trump. And the valuation is crazy on this one. The private investor paying for $45 per share. Private investor. And this thing is trading at 73, which doesn't make sense for me, but if you can see how the GameStop and the AMC is trading it, I was surprised they can stay high because it's Trump is a topic, right? All right, let's move back. So we get friends has launched those SPAC ETF, and then he had about 3% of his portfolio in DWAC before the announcement. The ETF had a big jump on that day. They're gonna announce the thing jumped from $10 to $130 in one day. Then he sold most of the positions and the book had a huge gain. So the SPAC, most of the deals are boring, but you will get some surprise like that one. If you get that one is a free gift, you just take it.
It's just amazing. If you're only screening stocks that are more than $50 a share, and you see this, what was the name of that last?
DWAC.
DWAC, and you see that it's just a regular tradable instrument. You have no idea that it's really this magical unicorn out here called a SPAC. You just think it's any other stock.
Yeah.
And you trade it technically just that way. You don't think of any fundamentals.
Well, yeah, I would say the mammoth stock is a different category. You have to think about it. They could be squeezed, went up a lot in a day. Like GameStop, AMC, this one. It was this stock jumped like 10% regularly in a single day, and it can be like jump 10% in one day and drop like 15% in another day.
Could I ask another question?
Yeah.
I hate it when people ask this question, because you can't really answer it the way people want you to. But what percent of these warrants expire worthless on these?
So that's a very good question. It happened one or the other way. So if the SPAC team cannot fund the deal, it's just going to expire. It just goes to expire worthless with the SPAC get redeemed when the money returned to the IPO shareholder after 2 years. They cannot fund it. And if they found a private company and get the deal done successfully, the warrants extend to 5 years. You got a 5-year lifetime. So theoretically, most of those warrants are still like tradable. It's not expired yet. So basically, you add 3 years time value to the warrant.
And these trade on the exchange.
Yeah, it's tradable on the exchange. And because you add 3 years more lifetime to time value to the warrant, it became more like valuable than like 20 cents maybe. Even though the stock, I saw some case, I can give you guys a terrible example for the company. Even though we made they tried to ask us to put some money down on the company, you can see it's get smashed. When the deal got closed, it immediately nose down from $10 to at some point $1.50. We heard a portfolio manager participated in PIPE, and his investment is roughly 50 million, and then he just screwed up whole thing for his family office. So it's completely toasted this ticker, so you can see. But even though the warrants for this ticker still trade at 30 cents, you get an $11.50 strike level, but you still trade at 30 cents because the time value is high. So people think that perhaps there's a possibility company made a big project that can jump back. In my point of view, it's not going to happen because I know the company well. So we avoid this company. Otherwise, we're gonna be killed by our investor. So that's the reason why SPAC became popular. And now let's talk about the comparison of SPAC versus the traditional IPO. On the traditional IPO, you might need to take a longer time to get the thing public. Typically, here, right, 6 to 9 months, but those days could go to 1 year. On SPAC, when the SEC is not that busy, you can get the deal approved within 3 to 4 months. And basically, you get a sure price and valuation for the SPAC goes to the SPAC, and the cost is typically lower than the traditional IPO. That's a major reason they want to go through the SPAC. It's about like 50 bips lower, or even sometimes can be like 1% lower on the royalty fee. So it's a big deal. If your size is huge, it's gonna save a lot of money for the thing. But other than that, I didn't see a major advantage on the SPAC. Basically, you can have faster time. You can save some money on the royalty fee. That's the advantage for the SPAC. For the traditional IPO, it just takes longer time to do investigation and high investment round rate. But in my point of view, most of the good company, they tend to the big good quality company trying to do traditional IPO because they don't want to dilute their shares with SPAC. They can go public. That their asset is high quality. They believe the buyer's gonna buy that. Yeah, that's the thing. So let's see some upside on SPAC for the investors, for the companies, you can get some very high quality partnership because especially the SPAC management team is formed by very experienced CEO from big companies. They know how to run the company. They can help the small private company to have a smooth transaction from the private company to a public company because they have experience, know how to run a public company, which is quite different from a private company. That's one advantage. The second advantage is, as I mentioned, it's has 3 to 4 months to get a deal done, and then you get the certainty to what's the shareholder base gonna looks like for your company because the thing already traded on the public market, and if the shareholder likes the company and likes the type company, they might just buy the share. All right, for the investor, then you know what the company you are looking for. They typically release the financial analysis and the financial projection on the target private company, and you also could have potential upside profitability on the target company, even though the odds are very low. But the good thing, you have redemption protection. That's the best thing for SPAC. You always have the exit protection for your IPO shares. If you don't like the private company, you always can sell, redeem it for the trust value. And that's it. Also for the SPAC, you also could invest some late stage startup company has a high potential. Because typically you won't find those companies on the public market, but they go to public through SPACs, which means some retail investor could also invest into those late stage or mid stage startup company, even though the risk is high, the reward can be high. So it's a balance you have to handle it, which is not open to retail investing in most of the case, unless you are qualified purchaser, participate in some private equity fund, they do like funding for those startup companies. All right. And the downside is basically for the sponsor quality sometimes can be shitty. It's a bad team and they have very bad valuation on the company and made a mistake to have higher valuation and screw up the whole thing. Also, when the space gets very crowded, as now you can see there's over 600 SPAC is looking for target company, and I wouldn't think that there are sufficient enough high quality company around the world to supply those SPACs, and they may get a trouble into that. And for the retail investor, if you don't know how to value those companies properly or do some research on target company, you might have a huge loss on that. But in my opinion, if those days you do a portfolio type, you do a basket type, you just short like 10 like recently closed SPACs, and if the redemption rate is not that high, your odds on making money is very high. And it's a little bit old, but it's kind of like we can see the most of SPACs are trading below this trust value. That's how the SPAC return looks like. It's kind of getting lower. Then you just start there. If you look at the, we can go to the SPAC income, SPAC insider to see the statistics. Yeah, kind of more fresh data. Why it's taking so long? Is that how it's internet? Oh yeah, that's just too much data. Yeah, here we go. Okay, yeah. Now you can see the year to mature, that's what I'm talking about. That's the average year to mature you can receive on SPAC. On average, you can get like, right now you can get about like a 2.8% year to mature, which means you buy on average, you buy the stock when they get expired on the deadline or they get funded year, you can get 2% and 8 on average return. So it's better than bond, right, John? And you always can exit. So that's the beauty of that. And we can look at some other numbers. In the 2021, that's the craziest year. You total launched almost 800 SPAC in a single year. And you can see SPAC existing since 2009, and you are not getting very popular until late 2019. And you can see that's when you see here this column liquidity means the SPAC has failed to fund a target company and redistribute the money back to the IPO investor. When the class finished?
Oh, we're doing fine. 12:05.
Okay, that's good. So as you can see, they had to return the money to the IPO investors, and we're expecting the number going to be high since then. So 2019, 2020 is still fine. You can see about half of the SPACs get the year, which means they get the deal down and successful close the year, and you get like still have 71 in the searching, the odds for those deals to get close is getting lower and lower, and still there's there's another 32 announced the deal means they are waiting for the deal to get closed. But for 2021, you end up has majority of the SPACs still looking for deals. And that's going to be a very big challenge for them to find a deal and get closed. So we are looking for a disaster there. But there's some opportunity for the investor buy the share and redeem it. You won't make a lot, but you make some. Like on average, you can make like 2%, 2.8%, which is decent enough. If you can get it a one-term leverage net fee, you may get close to 5% return. But if you are like very picky, maybe you can find some 3% or even 3.5% year to maturity curve. In fact, in our portfolio, most of the ticker has 3.5% year to mature. That's what we have. We just it's a no-brainer by the trader, by the stock trading equal or higher than 3% high. We just buy it and waiting for the redemption. This kind of save a lot of like headache to do that. And in fact, what else you can do is we also did we call it boost the income strategy. We sell a cover the cost on stacks because we bought, let's say we bought the share at 980, we write a $10 cover the call on top of that. We made maybe 5 to 10 cents per month or every month. It's not bad. 50 bips, you consider 50 bips a month, it's decent enough. And then if you're lucky, you get caught away, that's the best outcome. You make like 2.5% in a month. That's what the income strategy is looking for. So yeah, then you can see 2021 is it's a crazy year, and 2022 the IPO number getting cooling down. In fact, January and February we still have a lot of IPOs, and you can see if we go to the what's it? Maybe I can go to can organize the data. Yeah, if you look at on March, you only have 3 SPAC goes to the public market. But in the February, you have a roughly around 20 number. I will show you that, but roughly around 20 number. At January at about 30. Now people realize that, oh shit, the space getting so crowded. We may not be able to find any deals sooner or later. So we better wait until like the space getting clear up a little bit. Then they're gonna jump to. Now the experience, the team get more creative, like this Kensington Capital, they launched the 4 SPACs. They already done 3-1. We know the team very well. They did several good acquisitions, like Wallbox and one EV deal. I can't remember exactly, but they are trading above the trust value. And some of the other companies on no team, so you could have potentially very low quality with very with some unknown, like some small like underwriter like EF Hutton, iBank Security, be ready, and some of the underwriter with it's not like big enough to well know that like we typically do those big sell side firm like UBS, BOA, we do deals with them, but we never did like with EF Hutton or some of those names because we're not familiar well, and we also don't have a relationship with those underwriters. In terms of the returns, equal weight is a little bit higher. The reason is because the trust value is going up, so the return slightly goes up a little bit. And let's say we can have another view of those SPAC things. So this table shows you up like what's the voting date like. So typically they're gonna set up a vote date. They get a green light from SEC. SEC said you guys are ready for get a vote to close the deal. Then they're gonna set up. Typically they give 1 month notice before after they get a green light. But in some rare cases they can very rush. Give only 2 weeks to vote because they want to get the deal done as soon as possible. Then and you get the redemption deadline typically 2 trading days before the vote day, which means if you want to redeem your shares, you have to tell your broker on that day to get. If after that day, they only can give you like the best effort. They cannot guarantee to redeem your share. We get in trouble. So that's very important to read the message from your broker. Okay, let's see, and we can look at some statistics on how the vote redemption could be. This table very interesting, very, very interesting. I like this table. Now, and you can see here is the current share price, and this IPO size. That's a redemption rate. It's how much. This tell you how much IPO shares get redeemed by the investor, which means how much flow share remaining under the thing. And you can see the current unit price, the share prices, most of them are below the trust value. It's kind of nasty. Let's get the solid a little bit. I don't want to say something from 2010. Most
Click it again.
Yeah, now you can see this deal goes, they get a vote just last month, and the share price crashed down to $2.73 within a month from $10. But there's some deals like this one, they are trading above like trust value, and that's odds. So this one, the ISPO, I told my friend to short the name. Luckily, he got some borrow, and if you saw it, that's how the money being made. It's squeezed out to $100, and he just shot from 77 to 40 in 1 day, jump to 46. You're basically making a lot in 1 day. Even though the rate is very high, do you know? Guess what's the short rate? What's the borrow rate they ask?
Oh, for this, I don't know, 70%?
200% annualized. No, that's annualized. 200%.
Wow.
But you gotta pay like 1% in a day, but you made like 30% in a single day, so it doesn't matter. That's how the thing works. Like they see how things can be. It's like called short squeeze if you know the technology. How short squeeze happened? It's because the available trading share, the volume is low, and there's a lot of shorts. People are short this stock, and they need to cover their shorts, but the volume very thin. They have to pay a higher price. They just compete. The short investor have to compete each other to get the close position, so they push the price higher. If this one has an option, gonna be a gamma squeeze adds up, then that's the thing could go to 200. I'm not surprised. But this is already very crazy. You can see from $12 to 92 single day. That's short squeeze. And in most of the that's why you can see because 98%, 98.5% of the IPO share gonna redeem. They only get 1.5% like unredeemed IPO shares. So basically, the float share is very tiny. If those shareholders are waiting to sell those shorts, gonna be in big trouble. That's how you say that. And and you can see the spread is kind of huge. That's why I recommend that whoever wants short SPAC, do a basket. Don't short only one. If one off short, you may get in trouble. And you can see some of the deals. Jesus. Yeah, those common ECP is a firm in Houston, based in Houston. They're doing energy, private investment a lot in Houston. It's our friends. They try to ask us to invest on their pipe deal. We said no. I evaluated their pipe deal. I said no, we're not. Luckily, we got just the thing only at 177 today. It's kind of crazy. Yeah, it's a disaster. So if you look at that, most of the things are trading below $10. Only those one get a very, very high redemption rate. They get squeezed and the trading up about trust value. The reason is that most of those companies, like even though this one only have like 1.2 redemption, they still be trading at 630. You can scroll down and most of them are trading terribly. I would say 90% of that. So that's a game basically people can play. You can locate from your broker and show the company as a basket. On average, you may maybe be able to make 10% within a couple of days. That's but you just need to handle the risk. You have to have a stop loss on this on single name. Also, that's pretty much about the SPAC strategy you can play, and you can play long the searching gear and short some of the SPAC deal. Actually, there's some there's a 2 SPAC ETF you can buy. SPAC ETF. Yeah, basically this is the short SPAC ETF, the SPAC ETF. I remember the SPAC doing poorly this year. Those companies just buy the SPAC companies that they trading poorly. Yeah, you can see it stopped trading a couple of days ago. It's just get hammered, almost cut into half within 6 months. And the other ones is doing well. If you SO, what's the name? SOG. Yeah, you can see that's doing fine. Yeah, you can see a lot from us. So it's kind of very interesting. So that's basically that's a lot of opportunities in this game. Just be careful if you just want to make a bond type of return. You just buy the searching year with a high percent year to make sure if you want to have higher return. You just do short the specs. You just get the deal closed, so you might get a very juicy profit there. But you'd better to study the target company, see what's the company valuation, what's the company business model is, what they are doing. So it requires some fundamental research. So I have to review all those companies to make sure we're not shorting a good company. So that's a lot of work, but it was done.
Have you seen any option strategies on these ETFs that work?
They don't have ETF on those 2 options.
That's how they work.
Yeah, that's how they are. But they do have some on the SPACs. Some SPACs are very popular. They get ETFs. So basically, you can either short naked call or buy put. Is what I recommended. You can do to making some money, but you have to handle the volatility and you have to have a risk management system. So I think next time I will talk about more like how to trade in the volatility and option, etc. and what is key for next time.
Promise is promise.
Yeah, I'm gonna do that. That's and you guys all survive from the volatile market, making money or lost money?
Getting through it.
That's good. Yes.
Yeah, survival goes far.
Yeah. All right. That's all about my presentation. Is anybody has any questions? Anything? Stock market, SPACs. We do a lot of those things.
Well, Xifan, we can't thank you enough. And we certainly look forward to hearing about trading volatility from you. That's going to be fun.
Yeah.
And We really appreciate you coming. Hope you guys appreciate this guy. He's just an amazing person. And he never ceases to amaze me. So I guess it's spring break next week.